a significant shift occurred in the tax code today. For senior citizens and retirees, this particular under-the-radar modification has the power to determine whether thousands of your dollars remain in your bank account or are sent to the IRS before you're even aware of it. This isn't something you'll likely see highlighted on the evening news. Most tax professionals won't volunteer the information unless you specifically inquire. And by the time a large portion of retirees become aware of it, those funds will have already been paid out. This isn't conjecture, this isn't hearsay, this is a newly implemented IRS filing regulation that has just gone into force, and it has a direct impact on American citizens aged 65 and older. If your income depends on Social Security, retirement funds, a corporate pension, or even a small amount of work-related earnings, the information that follows is more critical than nearly any tax regulation you've encountered in recent years. This modification isn't minor, it isn't merely symbolic, and it isn't a permanent fixture. Actually, it has a strict time limit connected to it, and when that time period ends, the chance to benefit is gone. The reason this requires immediate attention is straightforward. If you fail to grasp this new regulation now, you cannot create a strategy to work with it. You cannot safeguard your finances against overpayment, and you might end up handing the federal government revenue it is no longer entitled to collect from you. By the conclusion of this presentation, you will have a complete understanding of what was altered, who is eligible, and why procrastinating or assuming a professional will manage it could end up costing you significantly more than you anticipate. Here's the aspect that virtually no one is articulating. Well, a fresh IRS directive has now been formally activated, permitting citizens 65 and older to take an extra tax deduction on their yearly filing, in addition to all the benefits they currently receive. For an individual who qualifies, this deduction amounts to $6,000. For a married couple where both spouses are eligible, it comes to $12,000. This isn't a tax credit. It's not a fleeting adjustment hidden in the small print. This is a straightforward subtraction from your total taxable earnings, actual money that is now shielded from federal income tax. In contrast to numerous tax modifications that assist only a specific demographic or demand intricate financial strategies, this one is broadly available to seniors whose earnings are within certain established boundaries. What makes this exceptionally noteworthy is that this deduction is added on top of the regular, standard deduction and the current additional deduction for older individuals that seniors have always received. Simply put, this means a substantial amount of retirement earnings can now be protected from federal taxation, provided you are eligible and you file for it properly. However, this is where the element of urgency enters the picture. This deduction is not permanent. It is valid only for a limited 4-year span from 2025 through 2028. After that point, assuming Congress does not vote to renew it, it vanishes completely. No exceptions for previous years, no ability to claim it after the fact, and no further opportunities. This means every financial choice you make concerning income, investment withdrawals, and the scheduling of these actions during this 4-year window has more consequence than ever before. This isn't something you can postpone understanding until a later date, and there exists a condition, not a deceptive clause, but a stipulation that many individuals misinterpret. This deduction begins to decrease once your annual income surpasses specific thresholds. For individuals filing taxes alone, the reduction starts at $75,000. For married couples filing together, it begins at $150,000. Once your income exceeds these levels, the benefit gets smaller and eventually is eliminated entirely. This makes careful planning essential, precise timing important, and incorrect guesses potentially expensive. What is particularly crucial to realize is that this deduction was not designed to reward elaborate tax avoidance methods or complex financial maneuvers. It was established to offer genuine assistance to seniors dealing with increasing costs, inflation, higher medical bills, and diminished spending ability during their retirement years. However, the IRS is not going to automatically apply this benefit simply because you are old enough to qualify. If you are unaware it exists, if you fail to file for it correctly, or if you arrange your earnings without understanding the mechanics of this rule, the benefit does not apply to your situation. This is the reason a significant number of retired people are in danger of overlooking it. Not from any fault of their own, but because no one has clearly explained the recent alteration and why it requires immediate attention. Before we continue, allow me to briefly introduce myself, so you understand why I am guiding you through this material and why the specifics are important. Hello, my name is Susan Harper, and my work involves translating intricate financial and governmental policies into straightforward, easy-to-understand language with a special focus on the types of rules that quietly impact retirees and older adults the most. There is no exaggeration, no fear-based messaging, no oversimplification, just direct explanation so you can make well-informed choices and avoid expensive errors. With that established, let's return to explaining why this new deduction is so unlike any other tax regulation you have encountered previously. For many years, seniors have grown accustomed to a single, fundamental framework regarding their taxes. Your options are to claim the standard deduction or to itemize your deductible expenses. If you've reached age 65 or older, you're accustomed to receiving a modest extra amount added to your standard deduction. That has been a consistent feature of the tax code for quite some time. Numerous retirees believe this is the complete picture. However, this newly introduced senior bonus deduction completely overhauls that entire structure. And this is precisely where individuals begin to underestimate its significance. This $6,000 deduction functions entirely independently from your standard deduction. It does not take its place. It doesn't compel you to pick one benefit over another. It is added on top of all the deductions you currently receive. This cumulative effect is what elevates this from a minor tax concession to a provision that can genuinely overhaul your tax obligation. What renders this particularly remarkable is that your method of filing, whether you itemize or not, is irrelevant. Typically, tax deductions require you to commit to one path. If you itemize medical costs, donations to charity, or home loan interest, you forfeit the standard deduction. If you opt for the standard deduction, you cannot claim most itemized deductions. This new senior bonus is unaffected by whichever route you select. Regardless of whether you itemize every eligible cost or you accept the standard deduction without detailing a single document, this deduction remains applicable. That characteristic alone establishes it as one of the most adaptable tax advantages for older adults introduced in many years. There's no complicated decision-making process, no disadvantage for choosing one way over the other. If you meet the criteria based on your age and yearly earnings, the deduction is yours to claim. To genuinely grasp why this is so important, you need to examine concrete figures, not vague percentages. Consider you're an individual taxpayer aged 65 or older. For the 2025 tax year, the standard deduction alone protects $15,150 of your earnings from federal income tax. Because of your age, you additionally qualify for the long-standing age-based edition, which contributes another $2,000. That part is not a recent development. What is a recent development is that provided your total income falls below the level where the benefit starts to decrease, you now include an extra $6,000 on top of that figure. When you total these three components, you're looking at nearly $23,750, of income that is never even factored into the federal tax calculation. This is not a legal trick. It's not an aggressive tax strategy. It is simply the current legislation. Now consider what this translates to in everyday terms. A large number of retired individuals manage on a mix of Social Security payments and modest distributions from their retirement funds. If close to $24,000 of that yearly income is safeguarded before taxes are even calculated, the effect can be substantial. It could be the deciding factor between having a tax bill and having no tax liability. It could mean the difference between using up more of your savings and protecting the assets you accumulated over decades of work. This is precisely why failing to comprehend this deduction proves so detrimental. Retirees frequently believe their tax circumstances are set and unchangeable, when in truth, a single regulation like this can completely alter the final outcome of their annual filing. And this covers only the scenario for a single person. The figures become even more impressive when you examine married couples, especially those aiming to make their retirement funds last for 20 or 30 years. However, before we examine that, there's a crucial point you must grasp, because this is where numerous individuals commit their first significant error. They learn about a new deduction such as this and presume it's applied automatically, that the IRS will simply include it without any action on their part. This belief alone is causing retirees to forfeit substantial sums of money. In the following section, I will clarify precisely why that idea is incorrect and what steps you need to take to guarantee this advantage doesn't bypass you unnoticed. One of the most costly misconceptions seniors hold regarding taxes is the belief that new deductions are implemented automatically. The idea that the IRS somehow recognizes your eligibility and quietly adds the benefit for you. That is not how the system operates. The IRS does not actively search for methods to reduce the taxes you owe. It merely processes the information you submit. If this deduction is not correctly claimed on your tax forms, it effectively does not exist from the IRS's viewpoint. And this is the point at which a surprising number of retired individuals end up losing money. Not because the regulation itself is complex, but because they fail to recognize an additional action is necessary. The positive aspect is that claiming this deduction isn't complicated. However, you do need to be purposeful about it. You must submit your taxes using either Form 1040 or the Form 1040 SR designed for seniors, and you must accurately indicate that you are 65 years of age or older. That straightforward checkbox initiates the calculation process that enables this deduction to be applied. Overlook it, hurry through it, or depend on outdated beliefs, and the benefit never goes into effect. This concern is amplified because this deduction isn't something the majority of seniors have encountered before. For many years, the tax framework conditioned retirees to think in a very restricted manner. Standard deduction, possibly a small increment for age, and that's the entirety of it. Consequently, when a new provision emerges, numerous individuals don't even consider searching for it. They presume nothing of consequence has been altered, but something has been altered, and it's substantial. And unlike refundable tax credits, which frequently are introduced slowly or demand particular eligibility, this deduction directly reduces your earnings subject to tax line by line. This makes precision essential. If you're utilizing tax preparation software, the computations are managed for you, but only if the correct details are entered. If you're collaborating with a tax professional, you need to verify they are informed about this new rule and aren't simply applying the previous year's method. This deduction is a recent addition, and new regulations are precisely where errors happen most often. Now let's discuss the income boundaries, because this is where misunderstanding truly arises. The senior bonus deduction doesn't vanish all at once. Instead, it is reduced steadily once your earnings surpass specific levels. For individuals filing alone, this reduction begins at $75,000. For married couples filing together, it starts at $150,000. Above those amounts, the deduction is lowered by $60 for each $1,000 of income above the threshold. This might seem minor initially, but it accumulates over time. Ultimately, if income reaches $175,000 for an individual or $250,000 for a married couple, the deduction is eliminated completely. No partial benefit, no alternative. It simply ceases to apply. This arrangement is deliberate. The deduction was aimed at assisting lower and moderate income seniors who are more susceptible to inflation, growing medical expenses, and reduced spending capability. From a legislative perspective, that is logical. But from a financial planning perspective, it means you must be fully aware of your exact income level. Even if your income places you within the reduction range, every dollar of deduction you can still secure is valuable. Partial deductions still represent financial savings, and those savings accumulate when you remember that this provision applies for up to 4 consecutive tax years. Overlooking a partial benefit because it's not the complete amount stands as one of the most frequent and expensive errors retirees commit. There's another aspect here that people often neglect. Your modified adjusted gross income doesn't solely consist of salary. It includes money taken from retirement accounts, earnings from taxable investments, revenue from a business, income from rental properties, and various other sources. This means choices about when and how you take income now carry tax implications that were not present previously. Taking a somewhat larger distribution from an IRA in a single year could diminish your deduction more than you anticipated. Distributing your income differently across multiple years could preserve thousands of dollars in deductions during this 4-year period. This is where careful timing becomes essential. And this is the reason understanding the phase-out regulations now, before you submit your taxes, holds such importance. But before we explore strategy in more detail, there's a widespread misconception circulating online that requires immediate clarification, because misunderstanding this aspect leads individuals to form seriously flawed conclusions about taxes on Social Security benefits. In the following section, I will clarify precisely what this deduction accomplishes and what it does not accomplish concerning Social Security, so you aren't misled into believing something that is simply incorrect. There is a notion spreading rapidly on the internet that this new deduction completely removes taxes on Social Security payments. That notion is incorrect, and trusting it could cause individuals to make extremely detrimental financial choices. This new senior bonus deduction does not by itself make Social Security benefits tax-free. The guidelines regarding the taxation of Social Security have not been modified. What has been modified is the portion of your total income that becomes subject to those existing guidelines under the current regulations. Social Security benefits become subject to taxation once your combined income surpasses specific thresholds. For individuals filing taxes alone, that threshold begins at $25,000. For married couples filing a joint return, it starts at $32,000. Combined income is defined as your adjusted gross income plus 1/2 of your Social Security benefits. If your income exceeds these levels, as much as 85% of your Social Security payments may be subject to federal income tax. That structure remains completely unchanged. What this new deduction accomplishes is a reduction of your taxable income following those calculations, which can significantly lower or even eliminate entirely the actual tax you end up owing. Here's an illustration of this in a practical situation. Consider a single retiree receiving the typical Social Security benefit, approximately $24,000 annually. Under the standard rules, a substantial portion of that benefit might be considered taxable. However, when you factor in the standard deduction, the existing age-based additional deduction, and this new $6,000 senior bonus, the overall amount of earnings shielded from taxation can actually exceed the taxable part of the Social Security income. In this instance, the outcome is minimal or no federal income tax liability. This isn't because Social Security was miraculously rendered tax-exempt, but because the available deductions eliminated the taxable income before any tax obligation materialized. This differentiation is crucial because if you mistakenly believe Social Security taxes have been abolished entirely, you might incorrectly evaluate how additional earnings will impact your situation. This consideration becomes even more vital when Social Security isn't your only income source. Many retirees have several streams of revenue. Perhaps you're taking distributions from an IRA or a 401k. Maybe you receive dividend payments from stocks or other investments. Perhaps you continue to work on a part-time basis or collect earnings from a property you rent out. All of these sources count toward your income and all contribute to your modified, adjusted gross income. This figure determines both the portion of your Social Security that is subject to tax and the amount of this new deduction you're permitted to retain. To illustrate the potential impact, examine a single senior receiving $40,000 in Social Security benefits, along with an additional $40,000 from retirement account withdrawals. Under the previous tax rules, this scenario might result in a federal tax obligation exceeding $7,000. With the new senior bonus deduction applied correctly, that tax bill is reduced by more than $1,500. This is not a hypothetical approximation, it is a direct consequence of how this deduction interacts with established tax legislation. For married couples in comparable financial situations, the amount saved can be even greater. And when you multiply those yearly savings across 4 separate tax years, the cumulative effect becomes quite significant. This is precisely why the timing of income matters so greatly. When you have some flexibility over your income, such as with withdrawals from retirement accounts, you suddenly gain the ability to influence how much of this deduction you manage to preserve. In certain circumstances, moving some income into these 4 specific years might be advantageous. In other situations, postponing certain income until after the deduction period expires could be the wiser choice. There is no universal solution that fits everyone, but there is one principle that applies to all. Neglecting to consider the interaction between your various income sources and this deduction is a mistake. Another essential point that often receives insufficient attention is that this deduction applies regardless of whether you are completely retired or still actively employed. Being 65 years or older is the sole requirement, not your retirement status. If you are 67 and still receiving wages even from a part-time job, this deduction can still be claimed, provided your total income remains within the phase-out boundaries. This is especially relevant for individuals in the process of transitioning into retirement. Perhaps you've decreased your working hours but haven't completely stopped. Maybe you've postponed claiming Social Security but are still earning a paycheck. This deduction can offer meaningful financial relief during those interim years when income can be inconsistent and financial planning is most challenging. This leads to a common concern for many people. They worry that claiming a newly available deduction might raise their audit risk or invite unnecessary examination from tax authorities. This apprehension is understandable, but it is largely unwarranted. This deduction is explicitly authorized by federal law. It is computed using standard government tax forms. And when it is claimed correctly and accurately, it does not trigger scrutiny any more than claiming the regular standard deduction would. The actions that genuinely increase risk are filing your taxes improperly, omitting necessary steps, or depending on unfounded assumptions rather than precise, verified information. In the next section, I will explain step by step exactly how this deduction is officially entered on your tax return, which specific forms are involved, and why the entire process is considerably less complicated than most individuals anticipate. Now let's discuss how this provision actually appears on your tax paperwork, because this is where anxiety often develops for a lot of people. The idea of a new regulation can make it seem complex, but in reality, claiming this deduction is much more direct than most seniors expect. When you prepare and submit your 2025 tax return in early 2026, you will utilize either the standard Form 1040 or the Form 1040-SR created specifically for senior taxpayers. The majority of individuals over 65 tend to choose Form 1040-SR, as it features larger print, a more organized format, and guidance that is simpler to comprehend. While completing the document, you will mark a box indicating your age is 65 or above. This straightforward action signals the IRS processing system to implement the age-related regulations that follow. From this point, the computation for the senior bonus deduction proceeds through a dedicated worksheet created specifically for these extra deductions. In practical terms, you are not creating anything new, making estimates, or providing justifications. You are simply adhering to a predetermined set of guidelines. A recently introduced schedule is used to figure this deduction, and it leads you through the procedure in an organized fashion. Initially, it calculates your modified, adjusted gross income. Subsequently, it implements the phase-out reductions if your earnings surpass the specified limit. Finally, the qualifying portion of the deduction is moved to your primary tax form, where it immediately lowers your taxable income. If you employ trustworthy tax preparation software, this process happens almost entirely automatically, provided you have input the correct details. If you engage a tax professional, the procedure is equally straightforward, assuming they are informed about the new regulation and implement it correctly. This illustrates why simply being aware is so crucial. The deduction doesn't demand specialized knowledge, but it does require careful attention. If you overlook it, no alert is triggered. The IRS will not send you a message inquiring whether you intended to claim it. If the deduction is absent from your filing, the system simply presumes you were ineligible or chose not to take it. What is reassuring is that this deduction does not demand any alteration to your lifestyle or your financial management practices. There is no requirement to spend money in a certain way, no need for a special account, and no extra paperwork beyond what you typically supply. It is an official acknowledgement embedded in law that seniors experience different financial circumstances compared to younger wage earners. This brings us to the fundamental reason this deduction was established. Over the recent years, inflation has steadily diminished the buying power of retired individuals. Healthcare expenses have continued their upward trend. Prescription medication remains costly. Property taxes, insurance payments, and basic living essentials have all increased. At the same time, many older adults depend on fixed or relatively fixed incomes that do not adapt quickly to economic strains. This deduction is not a handout, it is a corrective measure, one that recognizes these challenges and offers focused assistance where it is most required.